Yeah, I see that you are ready for the class. Good. I can see you are ready for the class. Yeah, this is good. I think we can start. We can start the class, and we'll start from where we left last time. So I want to share my screen. Then you confirm for me whether you can see the screen. When you can see my screen, whether you can see my screen. Can you see my screen? I want us to start. Good. If you are there and you can see my screen, I think we should start. Let me see those. Oh, yeah, I can see people are in. I hope my screen. Yeah, I can see. I see. Good. I want us to start from where we left last time. We see the match that we can do today and possibly tomorrow. If you can see my screen, I want to explain this part of the foreign exchange on what we call the forex risk. It's called the forex risk, the forex exposure, the foreign exchange risk, and the foreign exchange exposure. We say that the people who deal with foreign trading, they are faced by a number of risks that can be classified as either economic risk, translation risk, and transaction risk. We need to understand these risks, and as you look at them, the economic risk has a cash flow effect. Translation risk does not have a cash flow effect, but transaction risk has a cash flow effect. The translation risk is an accounting problem. When you talk of the economic risk, we say that it is the likelihood that an investment that is viable today may end up not being viable because of unfavorable exchange rates. A project could be favorable today, but it is not unfavorable in the future because of unfavorable exchange rate. You evaluate a project so well based on the current exchange rate, but the cash flows are generated in different periods during the project's economic life. They end up being unfavorable. That is what you call the economic risk. So this is a probability of unfavorable future exchange rate affecting the cash flows generated by a project undertaken in the foreign country. In effect, the values of the firm, thus decreasing the NPV of the project. I want us to demonstrate this with a small illustration. We say that a Rwandan investor has undertaken a 4-year project in the United States that is expected to generate $120,000 per annum. Required, determine the amount to be realized in Rwandan francs, given that the exchange rate from year 1 to year 4 are Rwandan francs to USD 102, 101, 199, meaning they are going down. The Rwandan francs is gaining against the, you are exchanging, you are realizing less, you are gaining against the foreign currency. If the cash flows are constant at 120, like this, we need to determine How much is the Rwandan francs realized? Annual cash flow is 120 in USD in each of the 4 years. Exchange rate is 102, 101, 199. Annual cash flow realized, you multiply the annual cash flow multiplied by the exchange rate, you will get the amount, the actual amount that is realized. Then we say that though the dollar cash inflow remain constant, depreciation in the exchange rate causes a decline in the local currency realization. Look at this, the amount that is realized over time, the dollar is the same, but the amount realized is decreasing. This is unfavorable to the investor. It may end up giving you a project with a negative NPV. The cash flows are decreasing, not the cash flows that are generated by the project, but the cash flows that are realized on conversion. That is what we call the economic risk. The next one is translation risk. We say that this is an accounting problem. Translation from your financial reporting and IAS 21, IAS number 21, it provides for the reporting of transactions for an entity with foreign subsidiaries, with foreign branches, with foreign interests. These subsidiaries are supposed to prepare their financial statements at the end of the year using the reporting currency. If the reporting currency is different from the transaction currency, automatically the cash flows will change. The amount reported may end up giving a loss. So this is an accounting issue with no direct cash flows. It arises when an entity with foreign branches or subsidiaries report a forex loss from converting foreign financial statements into its reporting currency. That is potentially influenced investor. It potentially influence the investor's decision. It may not have a cash flow impact, but an investor can look at it and make a decision that is not favorable to the organization. We call it translation risk. The next one is transaction risk. When it comes to the issue of the transaction, we say that it is the likelihood that the traders in foreign countries will incur losses because of unfavorable exchange rates. For example, assuming you are in Rwanda and you exported coffee to, let's say, US, you are supposed to be paid 1 million USD. That is the money you expect. And the exchange rate today is 100 Rwandan francs per USD. Let's say 100 Rwandan francs per USD. If you are paid today, you will get 1 million multiplied by 100, that is 100 million. If the payment is due in 6 months, then when you are being paid, you realize that the Rwandan francs has gained against the USD, and you find it at something like, let's say 80. It would mean you will be paid 1 million USD, but you will realize 80 million. You will lose a clean 20 million. We say that this is a transaction risk. The likelihood that the exchange rate is unfavorable to the traders in the forex market. These are the 3 risks that we deal with when we talk of the foreign exchange risk or the foreign exchange exposure. If someone has a question, you can ask before I take you to the way to mitigate these risks. Is there anyone with a question or something before I get you to the mitigation of this risk? Is someone saying that my volume is too low? Can you confirm, or it is your mic that is low? I don't know whether the others feel the same. Is there any other person who is experiencing that? Or Check your mic as well. Check your mic. It could be the end, your end, because I haven't seen someone else saying that. I can see someone says okay. Someone says that no, there is no issue. So please check on your mic. Good. So having looked at that introduction to the forex risk, the word hedging means mitigating foreign exposure, mitigating foreign risk. The common method used to hedge against the forex risk, and which we'll be covering, we start with invoicing in domestic currency, to do nothing, leading and lagging. I will explain all of them. Matching, option contract hedge, futures and forward contract hedge, money market hedge. I start with the first one, invoicing in domestic currency. This is something that the Americans have succeeded so well. Anytime you import from America, you pay them in dollar. Anytime you export to America, they pay you in dollar. They don't pay in other country currencies. That means to them, they are not faced by exchange risk. We say that invoicing in domestic risk, traders may invoice in Rwandan francs to avoid currency conversion risks. This work if they can dictate the payment term and there is a mutual agreement between trading parties. We have experienced these challenges where countries are losing a lot because of using the USD. You are in Rwanda, you cannot pay in Rwandan francs. When you are being paid, you are paid in dollar. You are not paid in Rwandan francs. It means that you bear the risk. And as countries grow, they get the bargaining power. And I'll give an example of what happened in Kenya in 2023. Kenya pays a lot of money in petrol and petroleum product importation. So it got a point where the government felt that Kenya was losing a lot in foreign exchange, and they asked whether there was any country that was willing to supply Kenya with petrol and petroleum products in Kenya shillings. Some countries in Asia offered, and one of them was Saudi Arabia. So the Kenya government has been paying petrol, diesel, kerosene, petroleum products using the Kenya shillings. That has helped a lot to stabilize the currency. And if you look at, since Kenya started doing that, the Kenyan currency just stabilized. Invoicing in domestic currency, trading in domestic currency is one way of mitigating the foreign exchange risk. It is only possible if you can dictate the payment terms and if the mutual agreement between trading party is in agreement. Number two, to do nothing. We say that it is a decision not to make a decision. It is a decision not to make a decision. It is a way to mitigate risk by not mitigating risk. What does that mean? It means that sometimes you can look at the risk and you just keep silent, waiting for whatever the outcome. There's nothing that you do. And this is where most small traders are. So sometimes trader may ignore exchange risk due to insignificance risk exposure, when you feel that the risk is not significant. Number two, expected favorable exchange fluctuation. When you are expecting that the exchange fluctuation will be favorable to you, you can decide not to do anything, to do nothing. The other one is leading and lagging, leading and lagging. And I want to explain what is leading, what is lagging. Leading means, okay, let me first give an example. If today you are in Rwanda, you exported tea on credit, let's say worth 1 million Rwandan francs. And the exchange rate today is 100 Rwandan francs for USD. You will be paid 1 million, multiplied by 100, you will have 100 million Rwandan francs. Then after, let's say you have exported and you expect to be paid in 3 months, in 90 days. Then after 1 month, you realize that the exchange rate is, or your currency is gaining against the dollar. You find that after 1 month, your Rwandan francs to dollar is 98. That one will tell you, if you receive the payment, you will take 1 million times 98. You will have lost 2 million. Then you realize that this trade is likely to make you have an exchange rate of 90 the time that you'll be receiving your payment. Leading means you can negotiate with those who imported, or to those who you exported, to pay you early. We call it leading. You accelerate the correction of the money or the payment of the money. That is called the leading. Lagging is to delay the payment or the receipt of the money. For example, you are supposed to be paid 1 million US dollar today, but because the exchange rate is not favorable for you, you can request you be paid after 2 weeks when the exchange rate will be favorable. We call it lagging. Delay in payment or delay in receipt when you anticipate the future exchange rate will be favorable. I don't know whether so far those ones are clearly understood. Let me see whether someone has a question on those methods. Someone is asking invoicing in domestic currency. Someone is asking the direct quotation and indirect quotation. Those are the questions that are there. Okay. Someone is asking the issues to do with invoicing in domestic currency. Invoicing in domestic currency. What is the meaning of that? I said that when you look at the American style of trading, they tell you that pay us in US dollar. When they are paying you, they pay you in US dollar. That one we say that they invoice in domestic currency. They invoice in their currency. In simple terms, you dictate and you force others to use your currency in your transaction. That is what it means. Someone was asking about the difference between direct quotation and indirect quote. Direct quote means the amount of domestic currency per unit of foreign currency, while indirect quote is the amount of foreign currency per unit of domestic currency. Direct quote, we say 1,000 Rwandan francs per unit of dollar. That is direct. That is a direct quote. You can say 0.001 US dollar per unit of Rwandan francs. That is indirect quote. We will be looking at it more as we continue with this so that we can understand from different perspectives. The other one is asking about to do nothing. You may decide to ignore the risk and wait the consequences. We say that it is possible when the risk is not too high, or if you expect the future exchange rate will be favorable, you don't take any mitigative measure. The next one is what we call the matching. The matching. It is one of the good methods for the traders who are involved in import and export. For example, If you are in Rwanda, you exported tea to the United States worth 1 million US dollar. You expect to be paid 1 million US dollar, possibly in 6 months. You export, so in your account, you will record that one as account receivable, which is a current asset. Because you do not know how much the exchange rate will be when you will be paid, you can negotiate with a foreign exporter. You import goods worth 1 million USD that you are supposed to pay at the same time that you will be receiving the payment for your export. That means you have an asset which is account receivable, you create account payable, you create a liability. It is called matching. Create an asset when you have a liability, or create a liability when you have an asset. So we say that it involves offsetting receivables and payables in the same foreign currency to avoid conversion. A Rwandan export goods were the 200 on 3 months credit. They could also import goods worth the 200 payable in 3 months, thus using the export revenue to settle the import revenue, the import payment directly. When you will be paid, you will just pay, you will not convert. That is what we call matching, creating an asset if you have a liability, or creating a liability if you have an asset. Now, those ones are more theoretical. Now we get to computation ones. And I want us to start with option contract hedge. Options contract hedge. We say that option is a contract, and in option, we have two types of options. There is, okay, let me first explain. An option is a contractual agreement where two parties agree to exchange assets in the future date at a predetermined rate. There are two types of options. There is what we call a put option and a call option. I want you to have it this way. Put means to sell, right to sell. Call means the right to buy. What is the meaning of this? In an option contract hedge, we say that one party has a right while the other party has an obligation. Let me put it here. In option contract hedge, in option contract hedge, one party has a right while the other party has an obligation. Has an obligation. We say that the party with a right is required to pay a non-refundable amount known as the premium. In this case, if you looked at this point, put option, exporter expecting to receive foreign currency sells it at a set price. So option contract hedge, I can put it here, option contract hedge, or option contract, contract gives the put option contract gives the seller a right and an obligation to the buyer. Put option contract gives the seller a right and an obligation to the buyer. So in this case, the seller pays the premium to the buyer. The seller pays the premium to the buyer. That is the definition of what we call the put option contract hedge, and I will have it like that. That one looks better. Then let me put this one again. I'll say for this other one, let me give it another definition. I say that in call option contract, gives the buyer, it is opposite, gives the buyer a right and an obligation to the seller. The buyer pays, because the buyer has the right, the buyer pays the premium to the seller. They are opposite of each other. And I know this one needs an illustration to understand. Let me explain it from this perspective. Illustration. A Rwandan trader export goods worth 15,000 USD payable in 3 months. They enter a put option to sell the Rwandan francs, to sell the dollar at Rwandan francs 102.5 per US dollar with a premium of Rwandan francs 1.5 per US dollar required. Advice if the maturity rate is 1. Let me make this one as 1. Rwandan francs to USD is 101.85 to 103.75, and number 2, Rwandan francs is 102.9 to 104.05 per USD. I want to make this thing very clear when it comes to the issue of the put option and a call option. I just want to give a general example. Let me give a general example. Suppose you are in Kigali and you have a piece of land. We are in the month of July, the last day of July. You intend to sell that parcel of land in October. So you intend to sell it in October because you have a project that you want to do in October. Today you have it, but you don't need the money. You need the money in October. Then there is another person who is due to retire anytime, but knows that the money, the retirement or the pension will be paid in October. And this person wants to buy land. You are the seller of the land. This other person is the buyer of the land. Then you meet. You need money in October. You don't need money today. And you have a piece of land. The other party will get money in October, doesn't have money today. You enter into an agreement that in October, you will sell that parcel of land to the person in question at 10 million Rwandan francs. At 10 million Rwandan francs. Now, when it comes to that date, there are a number of factors. There are things that will happen. The land may have appreciated such that you can sell it at 20 million, or it may have depreciated such that you can only sell it at 5 million. Alternatively, it could be at 10 million, what you agreed. What happened in such a case? Today, you don't know what the price will be, but you have agreed that you will sell that land at 10 million. The other party has agreed to buy it at 10 million. But what determines the decision at the end is the type of contract that you enter into. You can enter into an option contract. An option contract. But it cannot be an open option contract. It has to be a put option or a call option. I want to explain a put option. The put option gives the seller a right. What is the meaning of a right? And it gives the buyer an obligation. You, the seller of the land, says that you have a land that you'll sell at 10 million. When you enter into a put option, you, the seller, will be given the right. And therefore, you will be required to pay the buyer a non-refundable amount called premium. Let us assume that you pay 1 million Rwandan francs, meaning because of that contract, you have paid the buyer. And the buyer is the one who is buying your land. You are paying the buyer 1 million so that that contract can hold. When it comes to that day, you will sell the land. That premium you pay, it is like the power to make a decision, and it is like what would I call it? The power to force things when the month of October comes. Because you are the seller and you paid the buyer, if the land will be 10 million in the market, the buyer will sell. You will sell that land to the person that you gave 1 million. The net sale will be you paid 1 million. This person will pay you 10 million. You will have sold it at a lesser amount. If the land will be in the market at 15 million, you will sell. You will not sell to this person. You will go and sell to whoever the buyer wants to buy because you have the right. It gives the right. You can sell to anyone you want. So if the land will be more than 10, you will be selling to the person who will be willing to buy it at more than 10. Meaning you will not be confined to the contract. If the land in the market on that day, on that date, will be 5 million, it means that the buyer will look at it and say, no, suppose I buy a similar land in Kigali at 5 million. The question will be, you are in a contract. You as the seller, because you have the right, you will force the buyer to buy at 5 million even when the market price is 5 million. You will sell it at 10 million. So put gives the seller an advantage. But remember, the seller paid 1 million, which is the premium. The reverse is true for a call option. Call gives the buyer a right. If you entered into such a contract, the buyer will pay you, the seller of the land, will pay you 1 million as the premium. When it comes to the selling date, if the land will be costing in the market 15 million, the buyer will tell you, don't sell it in the market at 15 million. I will buy it at 10 because that is what the contract says. If the land will be costing in the market 5 million, the buyer will tell you, I will not buy this land at 10 million. I will buy it at 5 million in the market. So it gives the buyer power to make decision. And that is what you call option and the put option. Now back to the illustration. A Rwandan trader export goods worth 15,000 USD payable in 3 months. They enter a put option. Put gives the seller a right to sell Rwandan francs at 102.5 USD with a premium of Rwandan francs 1.5 per USD required. Advice if the maturity rate is 1. Rwandan francs to USD 101.85 to 103.75, or 2. Rwandan francs 102.9 to 104.05. We say the difference between the two prices is called the spread, and one of the price is the buying price for the currency, while the other one is the selling price of the currency. Let us look at the first case. Case 1. If the market price is 101.5 to 103.75, the first question we need to ask ourselves, is this a direct quote or an indirect quote? We are given to sell Rwandan francs 102.5 to USD. Can we have someone respond? Is this a direct quote or an indirect quote? Direct quote, yes, thank you. It is direct quote. It means the amount of Rwandan francs per unit of the USD. Now I see people understanding. If you have not understood, others understood. It is a direct quote, and I want to put it here as a note so that we get it correct. We say that this is a direct quote. This is a direct quote. And I'll say in a direct quote, the bank buys the currency at higher exchange rate, at lower exchange rate to sell at a higher exchange rate. And actually, the direct currency for you to be remembering is like any other business. If you are dealing with the sale of motor vehicle, you buy motor vehicle at low price, you sell at high price. If you are dealing with cabbages in the market, you go buy cabbages in the market from the farmer at a lower price, you sell at a higher price. That is how direct quote works. Let's go. The first case, we are told that the market exchange rate is Rwandan francs 101.85 to 103.75 per USD. This trader, we say that it is a put option. Who paid the premium? We can say that the premium is paid by the seller because it is a put option. Is that what we are told? We are told that they entered into a put option. We can put another note and say that since since this is a put option contract, the seller has a right, while the buyer has an obligation. The seller has a right while the buyer has an obligation. The seller therefore pays the premium to the buyer at the inception of the contract. And remember, it is not the buyer in this business. It is not the buyer of the goods that we are exported. The buyer in this case is the bank. The bank is the one that is buying the dollar. The trader will receive 15,000 US dollar, will sell to the bank. The bank is the buyer of the dollar. It is not the buyer of the goods. It is the buyer of the dollar. Case number one, the market exchange rate is given at this. We say that since the exercise, we call this price the exercise exchange rate. This price, the price entered into at the inception of the contract is called the exercise exchange rate. That is a point that I should have noted. Let me say that the price, the exchange rate agreed upon in the or at the inception of the contract is known as the exercise exchange rate. It is known as the exercise exchange rate. That is the price that you enter into when you are getting into that contract. Our exercise exchange rate, we are told that they enter a put option to sell at Rwandan francs 102.5 per USD. This is what we call the exercise exchange rate. So since the exercise exchange rate, let me put it this way. Now in the answer, I'll say that since the exercise exchange rate is Rwandan francs 102.5 1 of 0.5 per USD, the trader will look at it this way. Market rate, the trader will take the dollar to the bank will buy at 101. And because it is a put option, the trader will not sell to the bank at 101. He will sell at 102 because it is favorable. Since the exercise exchange rate is 101, the trader will sell the dollar to the bank at the exercise exchange rate, And this is the exercise exchange rate. It is better than selling at this market exchange rate. How much will be realized? Amount realized is 15,000 times 102. This 102, the one in the contract. It is giving 1537. But remember, this trader already paid to the bank. When they entered into the contract, the trader paid to the bank an amount of premium. We need to establish how much is this premium. This premium will be deducted because already the seller had paid to the bank. The net amount that will be realized by this trader is the amount 15,000 times 102, which is the exercise exchange rate, minus the premium. You get the net proceeds to the trader. I want you to look at that. I've tried to explain it. Just look at it for 1 minute, then you ask questions. Look at it, then you ask questions. So I hope you've looked at. Someone is asking why premium paid mean what? I say that is a term in an option contract. So that is a term, that is a condition in an option contract. It is a condition in an option contract. Is premium paid to the bank or to the buyer? No. It is paid to the bank. It is paid to the bank. Bank is the buyer of the dollar. Someone is asking a question there I don't understand. Okay, I believe you're asking, if you look at this, in the question here, we are told that with a premium of 1.5 Rwandan francs per dollar, and this transaction has $15,000. When you take 15,000 multiplied by $1.5, I believe it is 22,500. Maybe someone can confirm. I think that is the question you're asking, the computation of that premium. Someone says you got the point. That is good. I just wish that everyone could understand this issue. Why premium is less? Because you are selling dollars to the bank, but already you paid them money. What is your net amount? It is the money that the bank will give you minus the premium that you gave them. That is the reason we are deducting. Make sure that you understand that point because it might raise an issue when we will be dealing with the importers. Yeah, I think that one is okay. Let's go to the next point. We understand why this trader has decided to use the exercise exchange rate. But case 2 is, if the market rate is Rwandan francs 102 to 104, 102.9, we say that since the exercise exchange rate is 102.5, the trader will sell the dollar to the bank at the market exchange rate. Here, I'll put it here. I'll say that since the exercise exchange rate is 102.5, the trader will sell the dollar to the bank at the market rate. Why? Because if the trader sold at 102, they will realize less. But if they sold at 102, there is 102.5, it is not favorable to the trader. The trader should sell at 102.9 because this trader has the right. How much money will this trader realize? 15,000 times 102.5.9, or then less the premium, like that. How much is the net amount? This trader will realize the difference. In simple terms, we've said the trader here is the decision maker because they entered into a put option. The trader is the seller of the currency and therefore entering into a put contract, that trader is advantaged. That is very well explained. I want to explain another illustration. Let me explain another illustration. Illustration 2. A Rwandan trader import goods worth 12,000 payable in 3 months. This trader has imported goods payable in 3 months and enters into a call option. Because this is an importer, this importer is in Rwanda and will buy dollars from the bank. This trader is a buyer of the dollar, will buy dollars from the bank so as to pay, is a buyer. The most favorable deal for a buyer is the call option so as to enjoy the right. We are told that a Rwandan trader import goods worth 12,000 USD payable in 3 months, enters a call option at Rwandan francs 136.5 euros, a sterling pound. The premium is Rwandan francs 2.1 per sterling pound. Now the question is, advice on the best course of action if the exchange rate is Rwandan francs to sterling pound 135 all the way to 137.25. Then the second one, the exchange rate is Rwandan francs 134.32 all the way to 135.98. The question is, which is the best course of action? I will explain something. Let me first ask a question. From what you look at that quotation, is it a direct quote or an indirect quote? Let me first take you back to it. Is this a direct quote or an indirect quote? This one. Is it a direct quote or an indirect quote? Or in fact, we can look at this. Is it a direct quote or an indirect quote? Someone says, is this a direct quote or an indirect quote? I need someone to tell me, is that a direct quote or indirect quote? That is the question I'm asking before I respond to questions. Someone says direct. Someone says direct. Why do you multiply premium with the value of the goods imported? I thought a premium is fixed amount, not based on the value. Okay, that you say you thought, that is what you think, but it is not the truth. You are told it is the amount per dollar. It is amount per dollar. How many dollars are they? They are 15,000. You cannot leave it at 1.5. It is per dollar. How many dollars are they? Yeah, someone is trying to respond to another one. The premium is paid by the seller because he is given the right. Yes, he has given the right. Do we always see? I don't know. Your question will be answered by the next thing that you are doing, because you are looking at now. That was a put. In a put option, you look at the seller. In a call option, you look at the buyer. I think those are the questions that someone is saying you have included three parties. No, I have only dealt with the seller of the currency and the buyer of the currency. I said it is between the bank and the business person, the buyer of the currency and the seller of the currency. It doesn't include any other party. Let me explain this part. A Rwandan trader imports. This Rwandan is an importer of goods worth 12,000 payable in 3 months. When this buyer will be paying, he will go to the bank and buy dollar from the bank. This person is a buyer of the dollar to pay. The bank now becomes the seller. The bank becomes the seller. Unlike the other one, this one gives the buyer of the trader is the buyer of the dollar, because they need to buy the dollar to go and pay. If today you are importing anything in dollar, you will buy the dollars. You are the buyer of the dollar because you are importing to pay. The question is, if the exchange rate, if this, in this party or in this transaction, you should always be wise enough. If you are an importer, I would advise always enter into a call option. If you are an exporter, always enter into a put option. That is something that you should have in your mind. And if you do take notes, those are the points that you should have written. That if you are a buyer, always enter into a call option. If you are a seller, if you are an exporter, always enter into a put option. Let's get to the question. If the exchange rate is this much and the deal is 136.5, to starting port. You want to go and buy from the bank. That is option 1, case 1. Let me just put this one here. Let me put this one here so that we understand. Case 1, like that. The Rwandan francs 135.28 to 137. You will buy from the bank. The bank will sell to you at 137 because they are buying, they are selling. They will sell to you at 137. But you have an option to buy at 136. You will buy at 136 because it is favorable to you. Case 1, the buyer, let me put it this way. The buyer will buy the currency at the exercise exchange rate and not the market exchange rate. That is favorable. They will buy at the exercise exchange rate. So we take 12,000 multiplied by 135.5. This will give this much. Remember, this buyer having the right in a call option will pay to the bank. So this buyer will pay to buy the pounds and will pay the premium. That means the buyer will add the amount paid to buy and the amount paid as premium so as to secure the right. You add the two, and this is the total amount payable. Total amount payable. That is case 1. For the person who asked whether we concentrate with the seller, it depends on what contract you are in. This one, we are in a call option. We concentrate on the buyer. When we are in a put option, we concentrate with the seller. In case 2, this person, the buyer, will buy at the market exchange rate. We'll have it here. We say that the buyer will buy the currency at the market exchange rate, at the market exchange rate, and not the exercise exchange rate. Exercise exchange rate, because it is favorable. Remember, in option number 2, if I could actually copy this one here, it is important I put it here so that at least we say that 134, the bank is selling at 135.98, that. But the buyer has an option to buy at 135, where was it? At 130, at 136.5. This buyer will buy the currency at the market 135.98 instead of 136.5, so as to buy at a lower amount. This buyer will pay 16,160 to get that currency. But remember, to secure the right, this buyer paid 25,600. The premium, the total amount that is payable is the amount to buy the currency plus the premium, and this is the total amount payable. like that. That is the difference between a put option and a call option. It is actually something that is very important, something that is real in the world of finance. It's real in finance. I think I have explained and exhausted the option contract hedge. I would want you to sit down with your colleague, discuss this one, discuss it for you to understand. I will respond to one or two questions if there is any before we proceed to the next item. The issue is not adding or deducting, it is about understanding why we are doing it. You understand why are we doing it? Why are we doing it? But you can, okay, you can cram it and say that in a seller we minus and in a buyer we deduct, but I would only wish if someone could understand it. Are there other questions? I think that one there is no any other question. Someone is asking why do we pay, why is premium paid? I said it is to secure the right. Premium help you to secure the right. And today the turn up is too low. Too low. You are at 72%. That turn up is too low. I don't know what has happened. I don't see any other question. That is it. I said that was meant for computation. I want to explain the next item, and this is, remember we are on the hedging strategy, the hedging the foreign exchange risk. We've talked about do nothing, matching, leading and lagging, invoicing in domestic currency, the option contract hedge. Now we are looking at futures and forward contract hedge. Futures and forward contract hedge. A future and a forward contract hedge, they are a contractual agreement between parties for an exchange rate in the future. If you are a trader, you can go to the bank and tell them that I expect to receive money. If I bring that money in 3 months' time, what is the best exchange rate will you give me? You enter into a contract. They promise you, they commit to pay you. If you are an importer who will be importing on credit, you can go to the bank and agree when I will be paying, how much will you sell the currency to me? You agree early, you agree in advance on how much they will sell you the currency. We say that you enter into a forward contract hedge or the futures. Now, futures and forward contract hedge, they are a contractual agreement where parties agree on future exchange rate. The only difference is that futures is American, while forward is for any other currency. Let me put it this way. I'll say that futures contract is quoted in dollars, while forward is quoted in any other currency. Is quoted in any other currency. That is one feature that distinguishes between the two. We say that futures, because the examiner might tell you to explain the difference between the two. futures contract is traded in a formal market, while forward are traded over the counter. There is no formal market for the forward. And that is why in Rwanda you will not talk of the futures. You will only talk of the forward. Because there is no futures trading market in Rwanda. You will get it in US. We say that futures are regulated by Futures Trading Commission. While forward contracts are not regulated. The forward contracts are not regulated. The futures are regulated by what we call the Futures Trading Commission. If you go to America, you will find what we call the Futures Trading Commission. Like you have in Rwanda, the Rwanda Stock Exchange. Who regulates the trading of stocks in Rwanda? In Kenya, they are regulated by the CMA. The regulator of shares, sale of securities in the Nairobi Stock Exchange is the Capital Market Authority. We call it CMA. It is the regulator of trading of the shares in the market. We don't have the futures market, so we don't have Futures Trading Commission. Who regulates the trading of securities in Rwanda securities market? Maybe someone can give us. Can someone give me the name of the regulator for trading in Rwanda stock market, Rwanda securities market? You are the accountant, you should be knowing. Who regulates? Who regulates the trading? Rwanda Stock Exchange, is Rwanda Stock Exchange a regulator or it is the market? Who regulates the trading in the Rwanda? CMAC, Capital Market Authority, CMA, Capital Market Authority, Capital Market Authority. So it is, they got the same case like Kenya, the CMA, the Capital Market Authority is the regulator. It is good to note that. And the reason I brought that is so that we can understand what is the meaning of regulating futures in the market. Because in America, there are futures trading. There is the Futures Trading Commission. These are the main features that distinguish, and we can say that futures are, okay, let me put another point. The traders of futures are required to pay a refundable amount called the margins that act as security. No such margins are paid in contracts. Are paid in forward contracts. There's no such margins that are paid in forward. These are just security so that in case one party default, that money will be used as security. It is used to compensate the other party. I think I've given so many points about the distinction between the futures and the forward, but you'll find that more questions will be on the forward contract because forward is the one that is quoted in any currency. Let's have an illustration. Illustration 1. I want you to look at this illustration and tell me, look at this illustration. Rwandan exports 1.5 million Tanzanian shillings worth of goods. Let me use the word worth of goods. Payable in 3 months. We are given the spot exchange rate is this much. Forward discount is this much. Then we are given the forward exchange rate. Let me put this one. First, tell me, is that a direct or an indirect quote? Is it a direct or an indirect quote? Good. I see that some are saying direct, others are saying indirect. Is it a direct quote or is it an indirect quote? Is it someone says indirect, another person says direct, indirect. Look at this question. Rwandan exports 1.5 million Tanzanian shillings worth of goods payable in 3 months. Spot rate, Tanzanian shilling to Rwandan francs is 8.45 to 11.23. Is this a quote direct or indirect? Tanzanian shillings to Rwandan francs. This is an indirect quote. This is an indirect quote. Note that. Then we are given, this is spot exchange rate. Then here we are told that forward discount. If you can remember last time I said, spot, if you are given discount, how do you get the forward? Spot, if you are given premium, how do you get the forward? Here we are told the spot exchange rate is given and we are given a discount. What do we do on the spot to get the forward given a discount? Can someone tell me what do we do with the spot and discount to get forward? Someone to tell me, if you are given discount and the spot, what do we do? Someone says we add. Someone says, another person, we add the discount. Yeah, these are the students who are revising because we discussed this last time. All these things we have discussed. Always make sure that you go to the notes. We said if you are given a spot and discount, you add. We had said that last time, but there are people who still don't know what to do. We add. So let us see if we added this. We need to pick this one. We add. See whether my additions are correct. This one we add like that. This gives us, there's nothing easy like a forward, a question on forward. The forward exchange rate, if you take 8.45 plus 1.25, confirm for me that it is 9.7. I may have made a mistake. Or 11.23 plus 1.27. Can you confirm for me that it is 12.5? Then a Rwanda export. So this Rwandese will be paid Tanzanian shillings 1.5 million. When the person receives 1.5, this person will take to the bank. And let me just explain something here. Let me put a note here. Notes. This is an indirect quote. This is indirect quote. Therefore, the bank. This is where the reverse is. The bank will buy the currency at the higher exchange rate. Exchange rate and sell at the lower exchange rate. Because in an indirect quote, we divide. In an indirect quote, we divide. In a direct quote, we multiply. In an indirect quote, we divide. So the bank will therefore, the bank will exchange, this is an exporter. The exporter will sell to the bank The bank will buy the Tanzanian shillings at the higher, which is 12.5 Tanzanian shillings per dollar. Tanzanian shilling, not per dollar, per Rwandan francs. They will buy at the higher exchange rate. So the amount realized is 1.5 million divided by 12.5, and therefore they will realize 120,000 Rwandan francs. Look at that question and make sure that you understand what it means in a direct quote, in an indirect quote. Look at it. Okay, I can check the questions if someone has a question. And please don't ask obvious questions, the one that I have explained so many times. How you can know whether this question is direct or indirect quote, that one I will refer you to the notes because I have explained so many times. I think this question I started with it when we started this lesson. Someone asked, last time when I was crossing, I crossed with it. I will refer you to the notes on that. Someone is asking, which way can I know the currency with the higher value than other? Please don't look at the country with the higher value. Look at the way the currency is quoted. Look at the way the currency is quoted. Because if you look at the one with the higher value, you might find yourself in some trouble. Just look at the way the quote is done. Is it direct or indirect? That is the best way. Because any currency can be quoted either direct or indirect. Any currency. If you look at the notes that I gave last time, and which I gave after explaining, I explained so well the same currency quoted directly or indirectly. So please make sure that you check on that. Check on the notes every time that we are done with the class to avoid a circumstance where you will have piled notes and where you will find yourself asking the obvious questions. Okay, if there is no any other question, let us look at the next illustration. The next question, let me take you to another illustration. I decided to use many illustrations to make you understand. And I know if you follow this one, you will understand so well. But if you don't, I may not help much. But if you follow, you will understand. I've given very simple illustrations. Illustration 2, import. A Rwandan import goods worth South African rands 56,000. We are given spot Rwandan francs to South African rands, premium, then forward rate. My first question is, what is this a direct or an indirect quote? A Rwandan import goods were the South African rands. SAR is South African rands, 56,000. Spot is Rwandan francs to South African rand, 12.45 to 14.36. Is that a direct quote or an indirect quote? That is what you need to know. Is that a direct quote? Someone says direct quote. Can we hear from another person? Let us hear from another person. Is this a direct quote or an indirect quote? That is direct quote. Now it shows that people are understanding. If you haven't understood, then you don't blame me. You don't blame me. Don't blame Iqbal. Yeah, direct quote, direct quote, direct quote. That's good. That shows that people have started now understanding. Let's go back to the question. A Rwandan import good worth 56,000, and this individual is in. Let me put the question required. Just a minute. Required. Determine the amount payable in Rwandan francs. In Rwandan francs. I want this one. I want you to compute for me. This one. Can you compute for me? Give me the answer. Give me the answer. Please. Give me the answer. I want to see whether you are understanding. A Rwandan import goods worth South African rand 56,000. Spot is that. Premium is that. Determine the amount payable in Rwandan francs. Give me the answer down here. I need to see whether you people are understanding. Give me the answer. 2 minutes. I see the answers here. Someone is giving us 726, 320 Rwandan francs, 882,000. Another one is giving 726. Another one is giving, he said 4317. Another one did not get the question right. 726, 320. We have 3 people who have given that. Okay, let's look at it. 1, we have this part. This is a premium. We said that for the premium, do we add the premium or deduct the premium? We minus the premium to get the forward. Minus the premium to get the forward exchange rate. How much is this when you minus? How much is the premium when you minus? 1245 minus 1.24 and 1436 minus 1.39. Someone to give me the forward. Someone to give me. There are those who say they saw the answer. It's okay. That helped someone. Okay, someone says 11.21 and okay, let's see. I don't know whether this is the one. Did you say 11.21 and 12.97? Is that confirmed? Someone is very honest. We saw the answer. 11.1 and 12.97 or 96. If that is the case, this trader will Rwandan imports. This trader will buy the bank, will sell the South African rats at the will sell at the high at the lower exchange rate. Amount to realize is equal to amount that to be realized is equal to South African rats 56,000. South African rats 56,000. We divide by 12.21, 11.21. The bank will sell at the lower exchange rate. How much is that? 56,000 divided by 11.21. Let us have someone give me the answer. Oh, this is a direct quote. Sorry. I made a big mistake. I was treating it as indirect. The bank will sell the South African lot at the higher exchange rate. Someone did not correct me. At the higher exchange rate. So it cannot be that. It cannot be that. They will sell at 12.97. 12.97. It is a direct quote. Okay, it should be that way. Can someone give me the answer? Uh, 726,320. Is that correct? 726,320. 726,320. Yeah, I think that is what a majority are giving, which I would believe is correct. 726,320. That is the way to go about it. I have tried to explain and to demonstrate the forward contract hedge, the option contract hedge, and now I want us to go to the money market hedge. And because I want you to understand the money market hedge so well, I will allow you how many minutes break? As you take some water, you take some coffee, 9 minutes. It's 7:21. Let's get back at 7:30. 9 minutes break. 9 minutes break so that I can explain the money market hedge. The break starts now. Good. I think that was a good break. Uh, let's look at the next part. And I want to explain what is money market hedge. Money market hedge. Very important, very critical. I want to know, are you there in class so that we start? Are you there in class? Today the turn up is very low. We are at 75%. Someone says yes. Are we there in class? I see some people say yes, we are. Let us discuss the money market hedge. There is a method I explained earlier, and we talked of matching as a hedging strategy. Can someone light and tell us what is matching as a hedging strategy before I explain the money market hedge and how they relate with matching? What is matching? What is matching as a money market hedge? Someone tell me what is matching as a money market hedge. Someone can light? What is matching? I need to see what is matching. What is matching as a money market hedge? Someone is asking, what if we see it always in traders' perspective? No, don't look at it that way. Deal with the case by case. Deal with the case by case. Someone say we offset payables and receivables from same currency. Export and import done between receivables and payables. The matching is done between receivables and payables. The matching is done between receivables and payables, so at least it shows that people understand the matching is done between receivables and payables. We say that if you have a liability, create an asset, and if you have an asset, create a liability. When you export on credit, you have receivables, which is an asset. Just import on credit and at the same time to create a liability. That is what it means. But that may not be very practical in reality, because if you are a tea farmer, what will you import and who will give you the goods on credit? That is the question. What will you import and who will give you on credit if you are a tea exporter in Rwanda? What we do, an alternative way to do that is what we call the money market hedge. Money market hedge uses the same concept as the matching concept. We say that it uses the same concept as the matching contract hedge, but the creation of an asset by credit exporter. The creation of an asset by a credit importer, and creation of a liability by a credit exporter is done through the money market. It is done through the money market and not through import and export. What it means is that if today you exported goods, you exported tea from Rwanda on credit, you expect to receive some money in some future date. Instead of importing, you can go to the money market and create a liability. That creation of a liability when you have exported and creation of an asset when you have imported in credit is what matters in the money market hedge. I want to demonstrate this using an illustration, and I will start with the one for the exporter. Illustration. A Rwandan export goods worth $65,000 payable in 4 months. Then we are given, okay, the details that you'll get, information that you'll get is, number one, I want to give available information. Number one, we have the information about the money market. That is information number one. The money market. Just let me do this. Let me make it. I want to put it so that you can understand. Look at this. This is the money market information. In the money market, we are told you can borrow Rwandan francs at 8.4%, or you can borrow USD at 9%. You can invest. Lending means invest. Lending. You lend to the money market. You invest in the money market. If you invested Rwandan francs, you will earn 7.2%. If you invested dollar, you will earn 7.8%. This is what we call the money market information. The other information that you'll have is Forex market. Forex market. This is another information. We have the money market information. We have the Forex market information. The Forex market information, there is spot rate. The spot rate. We are given Rwandan francs to the USD is 102.45 to 104.25. Then we are given the 4-month premium is 0.65 to 1.02. Then from there, we are given the forward exchange rate. Let me have it that way. The forward rate, it is as a result of the premium that is given because you're given 4 months, and because it was premium, we must have deducted 102.65 minus 0.65, you get the forward. So the question is, use the money market to determine the amount, this being a Rwandan exporter. Use money market hedge to determine the amount realizable. Use the money market hedge to determine the amount realizable. This person has an option. The person has exported goods worth 65,000 USD. This person has an asset. That is what we need to understand. And I will first explain it here before even we say that this trader has an asset from credit sale in form of trade receivable amounting to 65,000 USD. Therefore, the trader has to create an amount, a liability, which is amount payable, through the money market. This is achieved by borrowing in USD. Because this person expects to receive USD, this person should borrow in USD. And how do you make the borrowing? How do you make this borrowing in USD? The person should borrow such that the amount borrowed today plus the interest payable over the 4 months period is equivalent to the amount receivable. Let me put that. The amount borrowed, today should be equal to the amount receivable at the end of the 4 months credit period. And I want to correct something. I've said that the amount borrowed today plus interest on this borrowing should be equal to the amount receivable at the end of the 4 months credit period. This person will have to borrow in the USD. We'll have to borrow in the USD. The question is, how much need to be borrowed and what is the borrowing rate? USD borrowing rate is 3%. If you look at the question, we are told that borrowing, money market, borrowing 8.4 Rwandan currency, USD is 9%. That is per annum. Borrowing, USD borrowing rate for 4 months is equal to 4 months over 12 months. You multiply by 9%. That is the way we are getting the 3%. That one need to be noted and be noted clearly. How we are getting the 3%. I believe, is that correct? Yes, I think that one is correct. 4 out of 12 multiplied by 9%, which is the interest rate per annum, that will give us 3%. So how much is the borrowing? The amount to borrow, let me put it here. Amount to borrow is the amount receivable discounted at the interest rate over the borrowing period. The amount to borrow is this amount discounted at the interest rate. So I can change this one and use multiplication, but this one I'll put it power -1. Power -1. Can you confirm for me that this person need to borrow 63,107 USD? Can you put that in your calculator? Discount 65,000 at 3% being a single period. So 65,000 multiplied by 1.03 power -1. Can you confirm for me that it is 63,107, please? Is that correct? Yeah, someone says it is correct. Someone says it is correct. Yes, it is. That is how you determine the amount to borrow. Now, once this money is borrowed, once the borrowing has happened, the amount is converted. I think I should have given this one in steps. Money market hedge. Let me do this. The trader has an asset. The amount to borrow. The next step is convert the borrowed amount. Let me go here. This trader has an asset from sale of this 65. Therefore, the trader has to create a liability. So step number 1, borrow. Let me call it step 1. Step 1, borrow in USD to create a liability. Borrow in USD to create a liability. Number 2, step 2, Step 2. Convert the borrowed amount to the domestic currency, to domestic currency at the spot exchange rate. We convert at the spot exchange rate, domestic currency at the spot exchange rate. So this is where we are saying convert to Rwandan francs. This 107, 63,107 multiplied by the spot exchange rate. Do we have the spot exchange rate? We are given the spot exchange rate. We are told that the spot exchange rate is 102 to 104. The bank will buy the currency. The bank will buy the currency at the lower exchange rate, 102. You have the dollar you have borrowed in USD. Take them to the bank, convert into the domestic currency. The bank will buy at 102. Your money becomes this much in Rwandan francs. Confirm for me. 63,107 times 102.45. Can you confirm that it is 64,65,312? Confirm so that in case I made a mistake, we'll correct. Please confirm and let me know. Someone says yes. 63,106,796. Is it true? 63,107 times 102.45. There's someone who says it is 63,106. 60. Can you confirm? Some says yes, there's someone who has given a different figure. I can see almost my majority says yes. So the thing is, we convert the amount. Step 2. Let me make sure that this one is correct. Make it bold. And also step 1. Make it bold. Like that. Convert to Rwandan francs. We have now the Rwandan francs. Then the next step, step 3. Step 3. Invest the amount in the money market. Invest the amount in the money market, or make any other investment with the money. Now, invest, we need to determine the investment rate. Because the information we are given here, we are given the information at the investment of the Rwandan francs. Investment rate, or I can call it the 4 months. 4 months investment rate is equal to 4 over 12. We multiply by, what was the investment rate? We are told that lending of the Rwandan francs is here. 7.2, 7.2. 7.2 is per annum. So we need to invest 7.2%, like that. How much is this price? Let me get, how much is this? I believe it is the 2.4%. 2.4%. So invest at 7.2 for months, which is equal to 7.2, 7.4%. Then the last step, step 4. Step 4. At end of month 4, at the end of month 4, the amount received from the export will be used to pay the borrowed amount plus interest, while the investment will be liquidated. The investment will be liquidated. So the step here should be liquidate the investment. It should be liquidate the investment. So how much is realized on this liquidation? At the end of this investment period, the investment will be liquidated. The amount that will be received by that customer, foreign customer, will be used to pay the borrowed amount plus interest. So what is the amount realized? The amount realized on liquidation is the future value of the investment. This is equal to, remember we invested 64.65, 312 times 1.024 for one period per 1. I believe this is the amount that will be realized. That is the process. So amount to be realized is this much. Amount realized is that much. And that is the way we go about the money market hedge. Someone to ask a question. Remember, let me go back to the question. The question was, are Rwandan export goods worth 65,000 USD payable in 4 months? Available information, money market, then forex market. We are given the spot rate. We are also given 4 months premium, and we are given the forward rate. Use money market hedge and also end the forward contract hedge, to determine the amount realizable in 4 months. In 4 months. In 4 months. So we've started with the money market. Now, because we have the forward contract, the forward exchange rate, let's determine the forward. The forward, we are given that this trader will receive 65, will go to the bank. The bank will buy at 108. So this one being the forward contract, forward exchange rate, we can now try to answer the question here. Forward contract hedge. This one. We have the forward exchange rate. Exchange rate is equal to Rwandan francs to USD 108.4. We say that this is a direct quote and therefore the bank will buy at 108.4. This is what will be realized in the forward contract hedge, and this is what is realized in the money market hedge. Money market gives 66.20, but the forward contract hedge gives 66.17. So the money market hedge gives more returns in this question. Money market hedge gives more value in this question. And I want you to ask a question, because this one I think is a very critical point. It is one of the very realistic areas in finance. Someone is asking why -1. I think I said we are discounting. We are discounting. We are discounting. Getting the present value is discounting. That is why power -1. What if we see it always in triple? What is this? Oh, someone is asking, we have not considered the premium. No, we have considered. The premium would only be considered in the forward. In the forward. That's where we have considered it to determine the forward contract hedge. The forward exchange rate, the forward exchange rate for forward contract hedge. It is not to be considered anywhere in the money market. Any other question? When we get the interest rate for 4 months, we make it a one period of 4 months. That is why we are using a one period. Someone is saying 1.024 is therefore negative. No, it is positive. We are determining the future value. The future value. It cannot be negative. It is the future value. It is the future value. Future value. That is why we are using power 1. Power 1, power 1. That's future value. Well, so there's someone who has understood everything that I've given and is asking for what we have not covered. Someone is asking about the futures contract, yet we haven't finished. Does it mean you have understood everything so far that you don't need what I have not finished? You need what we have not even gotten to? I don't know. I would wish you tell me that you have understood everything else. The only thing Remaining is what has not been covered. I don't understand what this one you mean. Why we are approaching it on the bank perspective. The whole thing is from a point of view of understanding. And that is what happened in reality. The bank is in the business of buying and selling currencies. As an accountant, you know that there are principles of accounting. There's a principle. You look at it from the perspective of the bank. But either way, the most important thing is understanding. The most important thing is understanding. It's not cramming who, what it is about. Do you understand? When you take money to the bank, you cannot sell Rwanda currency to the bank. You can only use the Rwanda currency to buy other currencies. Okay, so let's go to the one for importer. We see what happened. Importer. I'll say that an importer. Or let me call it a credit. A credit importer has liability. Trade payable has liability. Trade payable. Trade payables. Trade payables has trade payable. Therefore, they create assets in the money market through investment. Through investments, they create assets in the money market through investments. And this is what I want to explain. Let us have an illustration. Let's have an illustration for this. A Rwandan trader exports 2.5 million USD worth of goods. A Rwandan trader imports goods. Worth 2.5 million USD payable in 3 months' time. Available information. Available information. 1. Forex market information. This is forex market information. We are given the spot rate, Rwandan francs to dollar, and borrowing, that is spot rate. Then we have the money market information. Borrowing rate is Rwandan francs 9%, USD 10.8. Investing Rwandan francs 7.2, USD 8.4. Unless otherwise stated, the rates are given in per annum. Per annum. Step one is we need to make an investment. Determine the amount to be invested. Now, what do we need to invest? We say that the amount to be invested is such that the invested amount plus interest is equivalent to the amount payable, is the equivalent to the amount payable. What is the investment rate? We need to get investment rate. Investment rate is equal to investment rate, investment in USD rate is equal to the investment in USD rate is equal to 3 months over 12. We multiply by what is the investment rate from the question. We are told that investment 8.4%. 8.4%. How much is 3 out of 12 multiplied by 8.4? That's a quarter. Is it 2.1? I think so. 2.1%. Yes, 2.1%. That is the investment. The amount to invest is the present value. Amount to invest in is the present value of the trade payable. So amount to invest is equal to we get the amount payable, we multiply by the discounting factor 1.021 power negative 1 because it is the present value. Can someone confirm that it is USD 2.2448580? Someone is asking, why are you not using 7.2? What was 7.2? 7.2 is for Rwanda, and we are dealing with the dollars. 8.4 is dollars. We are dealing with the dollars. So we cannot use the Rwanda one. Rwanda one, I'll show you where to use it. Okay, I believe that figure is correct. I'm trying to check whether there is another question. Okay, I don't see any other questions. So we are seeing that investment in USD is that much. This is amount to be invested. After that, the question is the invested amount. This is step 2. Step 2, we say that the amount to be invested is borrowed in domestic currency is borrowed in domestic currency and converted into foreign currency. So how much is the amount to be borrowed? So we say that this, okay. Let me correct. Domestic currency at the spot exchange rate. So for us to get the 2448 USD, how much was it in domestic currency? So for the 2448, we say that the 2448 having been borrowed in domestic currency, it is equivalent to, we need to convert this 24, this USD, into domestic currency. How much was it in Rwandan francs at the spot exchange rate? You had the Rwandan spot exchange rate, you went to the bank to buy the dollar and you wanted to buy 24.48,580. The bank sold to you at spot exchange rate using the higher exchange rate, and this is the higher exchange rate, 103.76. That means that you had this in Rwandan currency, you went to the bank and bought the dollar, you got 24.48, like that. So the argument here is step 3. Determine the amount payable in domestic currency from domestic currency, which is the amount borrowed plus interest. of the credit period. Now, the domestic currency, the borrowing interest rate, is equal to, they borrowed 3/12 multiplied by what was the borrowing of Rwandan currency. Borrow the Rwandan currency. This one, borrow Rwandan currency at 9%. You will come here and give it 9%. 9% like that. How much is this? How much is this? Three over 4 times. So it is 2.25%. The amount to pay after 3 months is equal to, after 3 months at 2.25% is equal to, we need to take this, the amount borrowed, 254, this one, we multiply by 1.0225 power 1. 225 power 1. How much is this? Can you confirm whether 259 is correct? Someone to confirm for me whether that figure is correct. Is it confirmed? $24.48, $579. No, it cannot be 24 because we are taking 1.0225 power 1. It should be more than 254. It should be more, but not less. So that one is not correct because it is less. $258,781. 258,781. Is it 258 or 259? Someone to confirm. 258,781. Did I get it wrong? All right. $259,781. Yeah, I think that is the correct amount. Amount to pay after 3 months is this. And this is the way you determine the amount payable. Then we say that step 4, at end of credit period, the amount payable on credit import is settled by liquidating the investment in foreign currency, Remember, we had made an investment in foreign currency. That is the one that we invest. We will liquidate this one. We invested this one. It grew at this interest rate, so it will be exactly equal to the credit amount. That is what happened when it comes to the money market hedge. One thing I guarantee you, for all that you've done today, you need to revisit them before I explain more things. Otherwise, it will just be problematic if you don't go through them. I want you to go through what you've done today because it can be somehow tricky if you do not understand what we meant for today. And it will not be fair if I'm going to add anything more than that. We might find ourselves in trouble for no good reason. I'm trying to. I want you to first go through what you've done. Once you confirm to me that everything is right, we can continue tomorrow. But today we've done a lot that require a lot of concentration. They require a lot of concentration. Unless you want me to complicate life more, I would beg to stop there. And that should help us. Unless someone has a question, I will continue from there tomorrow. When it comes to the Forex, it means what it means. Send the notes. I will send the notes to the coordinator. For those who may send me a text on my WhatsApp, I will forward to you. Just send the message to my WhatsApp. Please don't. Someone says that today was very complicated. No, it wasn't complicated. It's only that we have covered so many things. It is not complicated, but I know you will understand it when you revise. So take your time, I have tried to use the easiest way to make you understand because I knew what it means when it comes to Forex, but with doing what need to be done, you will be able to understand. So you can send me a text on WhatsApp. I will forward you the notes. Yeah, so I will also send to the coordinator so that he can share the notes. Unless someone has something, I don't have anything more than that. So let's leave it at that. I'm just sharing the notes. If there is anyone who has sent me a text on WhatsApp, I just forward to you. That is what I'm doing. That is what I'm doing right away. I am doing that right away. Let me see. This. The notes are there. The notes are there. The notes are there. Just pick the notes. They are there. Good. Thank you so much. See you tomorrow. Have a great evening. When you receive those notes, please forward to others. Forward to the others. I may not be able to send to the entire population. So when you receive them, forward to the others. Forward to the others. Thank you so much. Thank you so much. See you tomorrow. Have a great evening and pass my greetings to your people. Pass my greetings to your people.